here on the losing side as well. Our market master of the day is with us, Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good to have you with us here. Good morning. Great to have you with us on CNBC-TV18. First thoughts, Nilesh, on the markets as they are set up as we start a new financial year, FY24. 23 over 22 in terms of at least index returns was kind of flat, although stocks did see a fair bit of damage. What's your prognosis? Will we improve or will it be a bit of a muddled market for the bulk of this year too?
So it's very difficult to take a one-year call in equity market. But my feel is that next year also we will see a lot of volatility based on events. If those events turn out to be in favor of India, then certainly markets can deliver positive return, because since almost August 21, markets haven't given any return. But if those events go against India, then markets may deliver negative return. For example, if you had asked me on Friday, I would not have been able to guess that OPEC will cut oil production by more than 1 million barrels and pull up the oil prices. Now, this kind of events will come and derail our equation.
Got that. The narrative. Nilesh, hi, good morning. This is Sonia here. Thanks for joining us. The narrative so far up until now is that you would make better returns in debt this year compared to equities, has shaped up very well. You think the tide is turning, or is that going to be the case as well in asset allocation? Better to allocate, more money to debt versus equity in this calendar year?
So I will certainly say that the certainty of making money in debt is far higher. Interest rates seems to be picking out in global markets as well as India. And we could see rate cut cycle begin towards the end of 23, beginning of 24. So this year, debt return will not only have coupon income, but also capital appreciation thanks to interest rates coming down. Whereas to generate return in equity, one will have to really pick up good stock and pray that events continue to turn in favor of India. But mind you, equity and debt is like so sunar ki ek luhar ki. 1 day's return in equity can overtake 1 year's return in debt in no time.
Yeah. Nilesh, debt has been a touchy topic as well, right? Overall, with all these taxation changes, and I was curious how you are thinking about this in terms of what has happened. That was another bolt out of the blue. No one was expecting it, did not find any mention in the budget, but there it was in amendments to the finance bill. What did you make of it, and what are your thoughts?
So this is a step towards new tax regime where there are lower taxes and no concession. This is also a step towards creating a level playing field among financial services. And we hope and pray that Finance Ministry takes this journey to the logical conclusion. On your channel, I have been advocating that this arbitrage of converting interest income through listed zero coupon debentures after 1 year and 1 day to long-term capital gain, which creates tax arbitrage of 29% this year and 33% last year, needs to be stopped. There is far more tax leakage in zero coupon listed debenture than what was there in debt mutual fund. Even today, different financial products continue to have different tax benefits. And I hope and pray that this journey of creating level playing field continues going forward.
No, but specifically with regards to what has happened to debt mutual funds, Nilesh, anecdotally, one was hearing that, some of these schemes in the last week of FY23 have seen inflows that they've not seen for a couple of years put together. If you can corroborate that, and what will happen from here out, in your opinion?
So undoubtedly, since this taxation changes were from prospective effect of 1st April, it created a window or a push for investors to take advantage of previous tax regime where debt mutual funds got indexation benefits and long-term capital gains. And many of them took the advantage. Going forward, we still believe debt mutual funds probably does not have tax advantage like before, but it continues to give you diversification for as small a sum as rupees 500. It gives you professional management, And most importantly, it gives you anytime liquidity. It's easy to enter into Indian debt market, but it's very, very difficult to exit. So we provide liquidity, diversification, and professional management. And that will continue to keep investors interested in debt mutual fund.
Okay. By the way, I just want to mention a couple of stocks to draw attention of our viewers. The Ashok Leyland stock is up well in the green. We were telling you earlier, it's a 19% growth that Ashok Leyland has seen year on year in their numbers for March. And medium and heavy commercial vehicle space, especially the bus segment, is doing very well since the reopening of schools and offices. The bus segment has gone up 72%, while the total MHCV segment is up 20%. Nilesh, there's a lot happening here, right, in this space. I mean, commercial vehicles has picked up. There is, of course, the price hikes that will kick in because of new emission norms. So there's a lot of pre-buying that's happening in this space. But in general, are you bullish on this theme? And how would you take it forward in the auto space now?
We remain positive on the auto space. Mainly first the passenger vehicle, then the commercial vehicle, and then the two-wheeler. In passenger vehicle, clearly there is a K-shaped recovery. There is more buying at the mid to higher end than at the lower end. There is a waiting period. Commodity prices have cooled off, and that has not been passed on to the consumer. So margins will be positively impacted. Finance cost has gone up, but it has not impacted demand significantly. So overall, passenger cars and auto components continue to remain on the positive side. Commercial vehicles are also benefiting from general economic recovery. The emergence of India as China plus one and also becoming part of the global supply chain management will continue to support commercial vehicle recovery. Two-wheelers have seen subdued demand, especially in rural India. Let's hope and pray that it recovers soon. But our preference right now will be auto passenger vehicles, auto components, and commercial vehicle.
All right. Hi, Nilesh. Good morning. Nilesh, if you want to stay protected from what's going on in the globe, maybe cement could be a play, right? And things have been moving well for them. Demand is reasonably strong. You have input costs that have seen a sharp downtick, which will help on the margin. And also, getting into an election year, normally you see good growth. How would you all approach this space?
Undoubtedly, we remain positive on cement. It's one commodity which can't be imported, so it has to be locally manufactured and locally distributed. Second, there is a huge focus on infrastructure build-up. This ahead of election gets a separate push. There is higher allocation in the budget as well as focus on execution. Put together, cement will be beneficiary, and we have seen in the month of Jan-Feb, for which data is available, the cement offtake has been fairly good.
Nilesh, we are on the cusp of another earnings season. What would you like to hear? Because, I remember after the third quarter earnings, your outlook had become a little benign, right? And rightfully so. You were pointing to slight stresses emerging in corporate commentary, even numbers which have been reported on an aggregate basis. Do you expect to see improvement? Because, you and your team are, I'm assuming, constant conversation with your investee companies, etc. as well. So you have a sense of what's going on. So what are you hoping to hear, and what's likely, in your opinion?
So September and December 22 quarterly results were below expectation for most sectors except some outstanding performance from banking and financial services. We have seen for the month of Jan and Feb some data which is improving. For example, rural consumption, which was subdued till December 22, seems to have picked up and is ahead of urban consumption from a growth point of view. We are also seeing substantial reduction in current account deficit with services exports picking up. Put together, I would like to see in March 23 quarter numbers, or at least expectations for future, a better outlook towards rural consumption and also narrowing down of current account deficit, resulting into either higher services exports or even pick up in manufacturing exports. If the corporate commentary is more positive based on March 23 results, or expectations of June 23. That will be music to our ears.
Okay. By the way, the market is not looking good. It's actually given up on a lot of its early morning gains. The Nifty is now down about 17 odd points. The Sensex is down 100 points. So not able to really hold up above that 17,000 mark convincingly, you'd have to say. What's under pressure now is a lot of these stocks, actually. IT is under pressure. Tech Mahindra, Infosys, TCS are all down and out. And BPCL, of course, because of the way crude has moved, is down about 3.5%. Nilesh, I wanted your thoughts on IT because, we're heading into earnings season now. And the hope is that Infosys will give out what could be the first look into FY24 guidance from the tech companies. Are you getting a sense that there could be more caution than positive updates from tech companies this time around? And if yes, how do you approach this space?
So my feeling is that IT is facing lots of headwinds ahead. One, there is worry about global demand. Second, there is worry on a medium to longer term basis about AI and ML disrupting at least some of the work which is done by Indian IT companies. Third, there is also challenges related to leadership transition we have seen in a couple of companies. Put all these things together, people will be looking forward to what is the commentary given by the IT management. Are they confident about growth? Are they seeing traction in overseas client order book? I think my feel is that IT sector is now bottom up. There will be separation of men from the boys. There will be few companies which may be able to withstand the headwinds which are coming up right now. But there will be a lot of disappointment also. So IT, from being a top-down sector, is now clearly bottom-up stock pick. Some will be winners and some may not be.
Nilesh, what about the entire earnings picture? Suddenly, in fact, the street started doubting that. There were some headwinds. Now we're split right down the middle. There have been some scaling back of earnings growth estimates as well. What are y'all penciling in for the next couple of years?
So it's very, very difficult to take a longer term call. And fortunately, unlike sell-side analysts, we have the luxury of not taking a yearly Sensex or Nifty EPS numbers. But clearly, there is a division at the middle. In Jan and Feb, some of the data has started showing that finally the problems which were constraining our economy seems to be behind us. Rural consumption seems to be recovering. Current account deficit has sharply come down thanks to rising service exports. Apart from IT and BPO, non-IT, non-BPO global capability center exports have also started picking up. Even on China plus one, we have started seeing some positive trends, especially in electronic component kind of industry. So overall, there is hope, but at the same time, there is also a fear in the market based on September and December 22 quarterly earnings, where other than BFSI, most companies gave little below expectation results. So either it's the number or it is the commentary. My feeling is that we are likely to see some volatility ahead in terms of earnings. Monsoon will come to know on 15th of April how severe El Nino will be and what will be the impact on Indian economy, especially agriculture and rural. Towards the end of the year, we'll also start factoring in May 24 general election and the outcome. So we are going to see volatile market. But as I mentioned, equities, 100 सुनार की एक लुहार की, one day's equity can overtake debt return for a year.
Okay, all right. We hope that day comes soon, right, Nilesh? Everyone's been waiting long. It's been a really frustrating last 6 to 12 months. But as you said, it pays to be patient in this in a market like this. So thanks a lot for joining in, and we will speak to you again very soon.